This video is for educational purposes only and does not constitute financial advice, investment advice, tax advice, or legal advice of any kind. Past performance does not guarantee future results. All investing involves risk, including loss of principal. NRI Wealth Lab is not a registered investment advisor. Always consult a qualified licensed financial advisor before making any investment decisions.
Welcome to NRI Wealth Lab. I am Ben, and today Bella and I are going to show you what 80 years of market data says about investing when war breaks out, and what the smartest investors do about it. Let us get into it. Bella, when war breaks out, markets drop. We all know that. But how bad does it actually get? Give me the real numbers.
On average, the S&P 500 drops just 4.4% following a major geopolitical shock. That is from LPL Financial's analysis of over 24 events since World War II.
4.4, smaller than I expected.
Second number, 18 days. Average time for markets to hit their absolute bottom after a conflict starts. Third, 39 days. Average full recovery back to pre-war levels.
5.5 weeks and markets are back?
On average, yes. And here's the critical point. The investor who sees that 4.4% drop on day one and sells in panic, they locked in their loss. Then watch the market recover completely without them.
Like jumping off a plane and then watching the plane land safely on the runway.
Exactly that. And it happens to millions of investors every single crisis. The core insight: markets fear uncertainty more than they fear war itself. Once conflict is a known reality, rational behavior returns.
Walk me through the actual S&P 500 numbers across 5 major wars.
World War II, 1939, down roughly 30% in year one. Makes sense. The entire global economy was being restructured by force.
Expected. Korea?
Korea, 1950, positive 10.3%. Stocks went up.
Up during a war.
Up during a war. Vietnam, 1961, also positive 10.3%. One of the most controversial conflicts in American history. Double-digit positive returns.
Afghanistan, after September the 11th?
Critical context: the market dropped 24.8%, but not because of the war alone. The dot-com bubble had been deflating for 18 months before the attack. Two massive forces collided simultaneously. Attributing that drop purely to the conflict would be misleading.
In Iraq, 2003?
Positive 26.7%. Nearly 27% gain in year one.
3 out of 5, strong positive returns, one dominated by a pre-existing tech crash. Only World War II caused a sustained decline.
80 years of data in 3 sentences. Markets are more resilient than headlines suggest. Every single time.
Give me the fundamental truths the best investors understand that most people simply do not see.
4 truths. Sit with each one. Truth 1. Markets fear uncertainty more than they fear war itself. The crash happens in anticipation of conflict. Once war is a known reality, the worst fear is already priced in.
The anticipation is more destructive than the event.
Almost always. Truth 2. According to Hartford Funds research, 73% of wars since World War II resulted in positive stock market returns 1 year later.
73%, nearly 3/4. That completely flips conventional wisdom.
That is why we call it the big truth. Truth 3. Time is your most powerful weapon. The S&P 500 has risen nearly 4 times since September the 11th, through 2 wars, a financial crisis, and a pandemic. Time in the market beats timing the market every single time.
Truth 4?
The most important. Panic selling is the most expensive mistake an investor can make. Missing just the 10 best days of market recovery costs you more than 50% of lifetime returns.
50% of lifetime returns, not from the war, from your own decision to sell.
The market did not cause that loss, the panic did.
Asset number 1, where should money actually go during wartime?
5,000 years of human history give us one clear answer. Gold.
The original safe haven.
The numbers: World War II, gold up 70%. Crimea 2014, up 16. Ukraine 2022 first quarter, up 14. Gulf War 1991, up 11. Afghanistan 2001, up 9. Because war always creates fear, and fear creates demand for assets that hold value independent of any government or currency. Gold cannot go bankrupt. It cannot be printed into worthlessness.
How does someone actually buy it? Not everyone has a safe full of coins.
5 practical options. Physical gold, coins and bars. Gold ETFs like GLD. Buy like any stock. Mining stocks like Barrick and Newmont. These often rise faster than gold itself due to operating leverage. Royalty companies like Franco-Nevada for lower risk. And gold mutual funds for broad exposure. Gold pays no dividends, but when the world is at war, it pays something more valuable. It pays peace of mind.
Asset 2. And I want to be honest, this one makes some people uncomfortable. Defense stocks. Investing in weapons manufacturers.
Completely fair. It is a personal, ethical decision each investor makes for themselves. My role is to present the economic data. Gulf War 1991. Defense stocks outpaced the S&P 500 by 30%. Ukraine 2022. The S&P Aerospace and Defense Index rose 12%, while the broader market fell 19, a 31-point performance gap in a single year.
Which companies specifically?
Educational context only, not a buy list. Lockheed Martin, RTX Corporation, Northrop Grumman, L3Harris, BAE Systems, Rheinmetall. For ETF investors, ITA and XAR track the sector broadly. DFN is triple leveraged, and I want to be explicit. Triple leverage means triple the risk and triple the potential loss, not suitable for most investors.
Asset 3. And you warned me this one would be jaw-dropping.
Yom Kippur War, 1973. Arab oil-producing nations launched a complete embargo against the West. The result?
How bad?
Oil prices surged 400%.
400%. The fuel that runs everything.
And triggered recessions across the entire developed world. Wars do not just disrupt stock markets. They rewrite entire economies through commodity shocks. Gulf War 1991. Energy stocks outperformed by 25%. Iraq 2003. WTI crude up 31%. Year 1. Ukraine 2022. Wheat spiked 50% because Ukraine and Russia supply roughly 30% of the world's wheat. ETF tools. DBA for agricultural commodities. XLE for broad energy. XOP for oil and gas exploration.
Some viewers are not chasing big gains. They just want to wake up tomorrow with their savings intact. What is the most defensive play?
A completely legitimate goal. Government bonds and safe haven currencies. U.S. Treasuries, the gold standard of financial safety for over a century. German bonds saw demand surge 22% in 2022. Swiss bonds carry a peace premium. Neutrality makes their debt a global refuge. And tips: Treasury inflation-protected securities. Their value rises with inflation. If war drives prices up, your tips investment rises with it. Purchasing power protected.
Currencies?
The US dollar. Capital flows toward it in every global crisis. The Swiss franc, perhaps the single most consistent safe haven currency in financial history. And for our viewers in Asia, the Singapore dollar is a rock-solid regional anchor, one of the strongest sovereign balance sheets in the world.
What parts of the stock market hold up best during wartime?
Certain sectors have historically beaten the broader market by an average of 8.5% during conflict periods. 6 of them.
Go.
Healthcare, XLV and IHF. People get sick regardless of geopolitics. Utilities, XLU and VPU. Water, electricity, gas cannot stop. Regulated returns low volatility. Boring is beautiful in a crisis. Consumer staples, XLP and VDC. People buy essentials, whether markets are up or down 30%. Agriculture and agri-tech, DBA and MOU. War-driven food insecurity benefits these directly. Cybersecurity, hack, and CIBR. State-sponsored cyber attacks surged over 200% after the Ukraine invasion. Modern warfare is as much digital as physical. And infrastructure and reconstruction, PAVE and IGF. Smart investors position for the rebuild phase while everyone else is still panicking about the conflict.
What should investors absolutely not do right now?
Knowing where not to go is just as important as knowing where to go. Airlines and tourism. Travel demand collapses in every major conflict. Emerging market equities near conflict zones. Capital flees to safety. Falling equity values and currency depreciation hit simultaneously.
Double pain?
Exactly. High-yield junk bonds. War raises default risk. Credit spreads widen sharply. Luxury and discretionary consumer stocks. Households cut non-essential spending while costs rise. Commercial real estate in conflict zones. Financing tightens. Occupancy drops. Insurance surges. And the most important one, panic selling your core long-term holdings. Missing just the 10 best recovery days costs more than 50% of lifetime returns. Staying invested through discomfort is one of the hardest and most financially important things a person can do.
Put it all together. What does a wartime-aware portfolio actually look like?
Illustrative only. A historical framework, not a personalized recommendation. Your situation is unique to you. 20% gold, 20% defense, 20% bonds and tips, 60% defensive by design. 15% energy and commodity ETFs, 15% defensive equities, and the final 10% in cash.
Why hold cash if inflation is eating it?
Because cash in wartime is not savings. It is ammunition. The buying power that lets you act decisively when panic creates the discount of a decade. The investor with dry powder when everyone else is liquidating. That is who builds generational wealth.
Cash is ammunition. Writing that down. Give me the playbook, not just what to own, when.
The best investors execute a 3-phase playbook regardless of how terrifying the headlines get. Shock phase, 0 to 3 months. Maximum fear. Rotate into golden treasuries. Do not panic sell. Add defensive sectors. Build cash to 10%. This is the single best time to buy conflict beneficiary assets. Fear is creating artificial discounts on exactly what you want to own.
The screaming moment is actually the buying window.
For the right assets. Adaptation phase, 3 to 12 months. Markets have found a floor. Increased defense and energy as government contracts materialize. Dollar cost average into quality blue chips. Rebuild phase, 12 months and beyond. This is where multi-generational wealth is actually built. Post-war reconstruction. Japan after World War II, Europe after the Marshall Plan. Drives decades of growth. Rotate into infrastructure. Reopen beaten-down sectors. Rebalance toward your long-term targets.
Shock, adapt, rebuild, crisis becomes a roadmap.
The investor who has a plan before the crisis hits is never at the mercy of their emotions during it.
What do the greatest investors say about investing through crisis?
These people did not theorize about crises from a classroom. They lived through them and built empires on the other side. Buffett, be fearful when others are greedy, and greedy when others are fearful. He looked at fear and saw a sale.
Easy to say when you are not down 20%.
Peter Lynch found that far more money has been lost by investors preparing for corrections than in the corrections themselves. Preparation for disaster often causes more damage than the disaster. Templeton, the time of maximum pessimism is the best time to buy. In 1939, at the outbreak of World War II, he borrowed money and bought 104 stocks at war panic prices. Every single one turned profitable. Every single one.
He bet on humanity surviving.
And won spectacularly. Dalio, in wartime inflation environments, cash is trash. Holding too much cash when inflation runs is a guaranteed way to lose purchasing power. Real assets, commodities, gold, tips, protect what you have built.
4 legends. One message, the informed investor sees opportunity where the fearful sees only danger. Close the content with 10 rules people can put on their wall.
Rule 1. Never panic sell. Markets recover. Permanent losses are self-inflicted.
The whole video in 3 words.
Rule 2. Diversify across at least 5 asset classes. Rule 3. Own some gold. 5,000 years of safe haven history. That track record is undefeated.
Undefeated in 5,000 years.
Rule 4. Increase cash to 10 to 15%. Dry powder for generational discounts. Rule 5. Dollar cost average into dips, not gut instinct. Emotion is the enemy of returns. Rule 6. Defense plus energy is wartime's dynamic duo. Government defense budgets rise during conflict. Mathematical certainty, not speculation.
Built into the system.
Rule 7. Inflation is war's silent tax. Protect with tips, gold, and real assets. Rule 8. Overweight stable nations. United States, Switzerland, Singapore. Rule 9. Build your plan before the crisis hits. The worst financial decisions are made under panic. Do the thinking in peacetime. Rule 10. Markets fear uncertainty more than war itself. When the fog of conflict clears, clarity enters. And clarity equals recovery.
10 rules. Everyone tested by history. These are genuinely gold, Bella.
Pun absolutely intended.
Bella, final thought. For the person watching right now who is genuinely scared, portfolio down, news terrifying, what do you say to them?
Every single crisis that has ever appeared on a stock market chart eventually became a footnote. The 2008 financial crisis. A footnote. The dot-com crash. A footnote. September the 11th. A footnote. The market absorbed every single one and climbed higher. What separated the investors who built wealth through those crises from those who did not was not intelligence or luck. It was knowledge, and the courage to act on it rather than react from fear.
Knowledge over fear. That is the entire video right there.
Financial freedom is not built by avoiding risk. It is built by understanding risk deeply enough to make better decisions than the crowd. War creates fear. Fear creates opportunity, and opportunity favors the informed.
Bella, this has been one of the most valuable conversations on this channel. Thank you for the data, the clarity, and for making 80 years of financial history feel genuinely accessible.
Thank you for the right questions. And to everyone watching, remember why you are here. You chose knowledge over panic today. That is already the right decision.
If this shifted something for you, share it with someone who needs to hear it. Hit like, subscribe to NRI Wealth Lab, and drop a comment below. Which of Bella's 10 golden rules hit hardest for you? Mine is Rule 1, never panic sell, because I need that reminder every single time. We will see you in the next one.